Welcome to the first episode of Biggi Invests. Biggi Invests is a show where I'm going to use my $65,000 portfolio as a starting point and give you full insight into everything that happens to it every single week. That means every investment, every decision, my thoughts every week, the ups and the downs, full transparency no matter what. In this first episode, I'll be taking you through my current holdings and walking you through my investment philosophy. So if this is something you want to follow along with, subscribe. Starting with my investing philosophy. My investing philosophy revolves around long-term investing in both growth and value stocks. I don't focus in or lock in on one distinct strategy or type of investment too much because I realize that different times in the market will provide opportunities in different types of stocks. I don't try to time the market. Instead, I consistently buy shares of high-quality companies over long periods of time. However, that doesn't mean I purchase shares of my companies regardless of valuation. Companies tend to flow between being overvalued and undervalued, usually because of short-term volatility, and they often don't stay at their exact fair valuation short-term. Therefore, I buy different types of stocks during different market cycles when the opportunity presents itself, which is usually during short-term dips. For example, in 2024, the general consensus was that tech stocks were pretty expensive, and I actually think that's still the general consensus here at the start of 2025. Therefore, in 2024, I was mostly looking for value stocks that weren't seen as attractive as the growth stocks. Stocks like Nike, Cheesecake Factory, and PayPal. On top of that, I was looking for companies facing short-term negativity that still had great long-term outlooks. Stocks like AMD, ASML, and a controversial one, Uber. Moving on, my ideal investments or the core positions of my portfolio are in high-quality, established companies with proven business models that dominate their markets, or companies that currently have incredible growth that I believe will grow into market leaders. By focusing on the best companies today and companies that have the potential to disrupt existing market leaders through innovation or simply by offering a better product or service, I'm able to position into the companies of the future and stay up to date on competitors that are threats to my existing positions. Going back to my core positions, I like businesses with predictable, consistent, and market-beating performance that deliver value to shareholders through dividends and share buyback programs, if they're well past their high growth days. Basically, what I mean by that is, if a company is not currently a market leader and is growing way faster than the average company, I'm fine with them reinvesting that excess cash flow in growth and taking more market share. These companies should operate in large, growing, addressable markets and be strategically positioned to avoid disruption in the foreseeable future. With large, focused positions in select companies, I aim to outperform the market over time. Next, moving on to the ideal characteristics of a company. These are the characteristics I look for when making an investment. First, I want my companies to hold a dominant market position in a large, growing market. They should have existing moats through either advanced technology, large existing networks, or anything that allows for pricing power. Second, I want revenue, earnings, and free cash flow growth well above the S&P 500 over the long term. I also want good return on capital employed, which is a measure for how much profit per dollar of capital employed the company makes. Next, I want a good management team known for beating estimates and one that conveys trust and accountability to shareholders. I like when my companies return value to shareholders through dividends or share buyback programs. Although, if the company is growing really fast, I'm okay with them reinvesting their excess cash flow back in the company for more growth. I want my companies to hold incredible balance sheets, especially if that company is more cyclical or could get hurt in tougher economies. Think about the Cheesecake Factory during COVID. They needed a ton of cash on the balance sheets to make it through to the other end because essentially they were forced to close their restaurants for a period of time. I like asset-light companies with predictable, growing cash flow. This could be something like a SaaS company or any sort of subscription model, or just a sticky product, something that consumers will continue to purchase. Lastly, I want organic growth. I don't like big acquisitions to promote growth. Companies with these ideal characteristics often trade at valuations higher than the market average, and for good reason. Now, while I am investing for the future, often in companies with high growth and innovation, I still prioritize value for my investments. Will not overpay for a company if I believe it is trading well above its fair valuation. Instead, I seek opportunities to buy these companies during dips particularly when short-term uncertainty creates attractive entry points without fundamentally disrupting the business model or long-term growth. When you accurately identify a short-term problem and capitalize on the negative price movement by buying the dip, I think it is only a matter of time until some positive news or developments take the price higher again. I believe this is a winning strategy. Moving on to how I do my research. I only invest in companies that I research sufficiently. My research includes reading annual reports and quarterly reports, listening to conference calls and any investor conferences or investor presentations a company may provide. I also like to watch any interviews that the management team, specifically the CEO, does. I focus on qualitative fundamental research, which is the story, how I think products will be used, and the non-numerical aspects of a company, and really try to understand the industry and its future as well as I can. Quantitative fundamental research, or the financials and the numbers, is of course also important, so I consider that too. I do this to understand the fundamentals, products, challenges, and potential growth of a company at the highest level possible. By holding focused positions in a small number of companies, I really aim to stay on top of all news and developments that concern my companies and the industries they operate in. Moving on to Spec Stocks. With a small part of my portfolio, I'm looking to invest in business models that may still be a bit unproven, but have a lot of potential for disruption and innovation. My positions in these companies are very small to both reduce downside risk due to the highly speculative nature of them, and because if they succeed, they can multiply so fast and grow into sizable positions in my portfolio. A recent example of this was Fubo TV. Fubo did its job in my portfolio and returned between $7,000 and $8,000 in a single trading day here at the start of the year. I exited the position to buy the dips on AMD, ASML, and Uber. Next up is diversification. I stay diversified by owning companies in different sectors serving different purposes and markets, and by owning different types of companies. And what I mean by that is owning both growth and value stocks. During different market cycles, each type of stock may be valued differently. By owning both types of stocks, I should always be able to find a deal in any market. I do not want to over-diversify by owning a large number of stocks. As I previously mentioned, I only invest in stocks and sectors that I understand on a high level. By owning 20 plus stocks, I won't be able to keep up with all those companies and sectors. Therefore, I aim to own around 10 to 12 stocks at any given time. This number may change over time, especially as I continually research more and more stocks year after year. But I believe this number of stocks, along with my high understanding of them, keeps me diversified enough. When it comes to risk and how I view the price action of my companies, it's important to note that I'm investing for the long term. I hope that my companies go down in the short term while I'm gradually building out my position. For example, if I'm interested in a company when it's priced at $100, why wouldn't I want to buy more shares at $75 as long as their long-term story remains intact? I think it's almost impossible to consistently predict macroeconomics and human emotions when it comes to the stock market. And that's why I think economists, analysts, and investors are constantly wrong when they try to make those predictions. I try to avoid making those predictions or basing my investments on what's going to happen in the next 12 months. And ultimately, I just don't judge my investments on their performance in the first 12 months. I will continue buying during market highs and market lows. Next, I want to talk about how I avoid timing the market. I avoid timing the market by buying stocks every week, every Friday specifically. That means I have money deposited into my account every Friday and I buy shares of companies that I believe are a good deal at the time. This forces me to constantly stay up to date on the valuations of my holdings and allows me to constantly invest over time and capitalize on any dips that the market presents. Lastly, I want to touch on when I would consider selling a stock. One, if there's a fundamental change in the business model or the company's competitive advantage, I would consider selling. Second, if there's simply a better opportunity out there, I would consider selling. I never try to trade based on negative market sentiment or in hopes of perfectly timing a crash. There's almost always going to be negative sentiment or some piece of data or history that makes it seem like the market will crash 50% tomorrow. What I've found to be true over time, although the bears can sound really intelligent, they're rarely right twice in a row. Okay, now to the real reason you clicked on the video, the actual portfolio or the starting point of the show. So in the past year, we're up roughly 40%. That's compared to the S&P 500's 25% or so. So in terms of returns, it's been a pretty good year. Moving on to the holdings, you'll notice that most of these companies kind of fall into two categories. First, companies that have great growth, and I believe will grow into dominant positions like AMD, Shopify, SoFi, Health, And then the second category, which are companies that have been facing a lot of short-term negativity and have really been left behind in the past 2 years or so. And some of those are making a or were making a decent return in 2024, like PayPal, Cheesecake Factory, ASML, um, Uber here, Celsius, and then Alf. A lot of those companies have really taken a beating. I've been in the market or following the market for about 5 years, but I never really had real money to invest until about a year ago or the end of 2023 specifically. And that's when I moved over to Robinhood. So this is the actual data that I have here. Lastly, I am creating a Discord to try to build a community of like-minded investors. So join that using the link below if you're interested. I will be sharing my research and talking about stocks all day in there. And if you want to reach out to me directly, Instagram is probably the best place to do that. So reach out if you want to chat. That'll be it for this first episode. See you in the next one.